What's going on, guys? Bexio, and today we're looking at the stock market to see if the bear market is over. If maybe we finally found the bottom, as the Nasdaq had a little rally last week. The S&P rallied as well, and even the Russell. Little rallies here. A little bit of optimism, as you know, the weeks before this were historically down weeks. The historical run of down weeks, I think, since something like 1930 or something, 1932. So we've had a big downtrend. We had big collapses. The Nasdaq went into bear market, and the Russell. The S&P briefly went into bear market, but then this rally came and we actually avoided that. But is the bottom in, or is this just a rally during a down market that ultimately will just get sold off like we've seen so many done before? So everyone wants to know. That's the big questions, but we can look at this right here. Some things to kind of talk about what's going on maybe in the economy, in the stock market. Talking about, we know the Nasdaq was up 3.33%. So the Nasdaq is in a bear market, so it remains solidly in a bear market. Also broke a run of 7 weekly falls, rising 6.8%. The Dow Jones rise marked the end of an 8-week losing run, and its longest since 1932. And the weekly gains for the Dow and S&P 500 were the biggest since November 2020. So a lot of things going on. We had breaking streaks of over a month. For the Nasdaq, had almost 2 months that it broke down. The Dow Jones had 2 months. It had 8 weeks of downward moves. We're continued moving lower and lower and closing lower. And we finally broke that. But is it just a bounce because it's been so down and so negative, and maybe it's just shorts covering because they've obviously made a lot of money because everything kept going down? Big questions to ask, and the biggest move up since November 2020. Maybe if the shorts don't reopen again, we'll be all right. But if shorts start to reopen, or if we see any type of negative news, then the market will probably go back down. We also have here Michael Burry. We can have his tweet right here. It says U.S. personal savings fell to 2013 levels, the savings rate to 2008 levels, while revolving credit card debt grew at record-setting pace back to the pre-COVID peak, despite all those trillions of cash dropped in their laps, looming a consumer recession and more earnings troubles. So that's, he's probably right. I don't know why he didn't delete this tweet. It seems like he always tweets something and then deletes it, but this one he didn't delete. So must be pretty confident in this stuff. But the charts that he links are completely right. They look terrible, and they're just not good. Despite, obviously, we know the trillions that skyrocketed earnings. So big tech earnings, they had massive numbers, they had massive sales. We saw this happen with Netflix, that it dropped like 70% because it lost subscribers, it lost that momentum. It had such a boom during this pandemic stuff when no one had anything else to do but watch some Netflix, and now they lost those subscribers as people found out they either don't have the money to keep paying Netflix, or don't have time or enjoy anything Netflix is doing. So there's a lot going to that. And the big tech and earnings can have the same thing, where Apple might have sold way more iPhones and iPads and stuff, as people just bought them because they knew they were going to be stuck at home and they were going to use it to watch entertainment or even work from, maybe. So a lot of things came from that. But these charts that he looks at right here is the credit card loans, consumer loans. So credit cards, things like that. And you can see we had the massive drop in credit card debt, and that coincides a bit with stimulus, with obviously getting free money. You might as well pay off your debt and basically get debt free without needing to use your own money. But now we've seen it curl tail and go all the way back up, and it's basically at levels that were the pre-pandemic. So 865, this drop was at 858, somewhere around there. So it's above those levels. People have more credit card debt now than they did before the pandemic. And combine that with the personal savings rate, and you can see this is super zoomed out, but you can see this absolute collapse, 4.4. So 4.4%. And before everything, it was 7.3%. So cut in half, basically, the savings rate from pre-pandemic levels people do not have savings. That might show that they're digging into savings to pay for things. So the necessities, all those things, and they might not be buying other things like iPhones, iPads, all those discretionary things that companies need for their earnings. So that's not good for company earnings, as well as if they don't have the money for, if they're losing their savings and they're in more debt than they were before. Combine those two things, just the consumer isn't in a healthy spot, which obviously means spending money isn't something that they're all right with. It's easy going. They're going to be marking every dollar they spend. They have to make sure that they can buy necessities, and that's probably it. Not really looking into anything else, which affects companies. But when you look at the stock market, so even looking at the stock market, you can see this not always correlated to the economy. Like the economy is not always the stock market, and the stock market is not the economy. We've seen that before in 2020 stuff. The economy a little rocky maybe, but the stock market doing great. And now we see the stock market and economy both fell hard, but now the stock market is starting to rally, and the economy is still not in a good spot. So it is possible for the stock market to rally and do good, even if the economy isn't in a great spot. One of the biggest things affecting the stock market right now is the federal funds rate, the interest rates, and what the Fed is doing. So right now we have the uncertainty about how high the federal funds rate, currently at 0.75 to 1%, will ultimately go. Market pricing points to a so-called terminal rate between 2.5% and 3%. But anything that hints it will be higher than that will rattle investors. So the big point, the federal funds rate, right now, market is pricing in a move up to 2.5% to 3%. If Jerome Powell comes out tomorrow and says the plan's to go to 4% and we're going to raise by 0.75% and do all of this, then the market's going to fall hard because it's not expecting that. It doesn't want that to happen. But if we stay on track, and I think this is probably the most likely outcome, is if we stay on track and just kind of continue getting to 2.5% to 3%, that's not going to be a surprise. Market's expecting that. Everything will go on as planned. If inflation gets worse and the Fed says we need to really ramp this up and Paul Volcker this, then, things get really, really bad. Things are going to fall insanely hard if Jerome Powell comes out and says, today we're raising rates to 9%. That'll be complete chaos. No one will expect it. And that'll be a rug pull on the stocks from Jerome Powell. So if that happens, things are falling hard. But hopefully we don't have to see that happen. And something here as well, talking about the bottom, says history suggests that both growth and inflation need to weaken further before a bottom occurs. I guess inflation would be a big thing for that, because if inflation runs rampant, people don't buy things besides necessities, and then you don't have growth. So if you do need inflation to go down and let people be able to actually buy things and be more comfortable, but right now it does seem that maybe the bottom of the market did happen. Looking at the S&P 500, we can see just kind of this downtrend that started up here. We've broken the downtrend yet again. We have done that before, but ultimately fell hard back to it and below it. But now we have this line that we're interacting with, the 415, which we're actually over just a bit right now. But it's pretty much been a major interaction where we see our first fall down. We fell down hard, but got bought up insanely hard here. Came down, bounced off it twice, and then a huge rally, ultimately leading to the sell-off. But again, lots of interactions here, and then we broke down, fell down below it, and obviously interacted with the downtrend, and then broke this with a big breakup all the way to this line almost exactly. And we'll see if we can break this line and stay above it and kind of use it as more support. If we can get rid of this insane downtrend, then we'll be good. But we've seen the rallies every time get sold off. We see a rally and it kind of was sideways, sold off. And then this kind of just trading sideways and down, massive rally, little bit of sideways, starts selling off, and then sells off hard, going sideways, big sell off, even mini rally with a sell off, and now we're having another rally. But is it going to sustain? That's the big question. I think we need to stay above 415 for it to sustain, obviously, and just kind of make this a support level that we can keep going up from, because a lot of negative news would be priced in right now, and hopefully there's not something that's that crazy that can just throw a wrench into the entire market besides the Fed coming out and just Paul Volckering everything. So maybe the stock market bottom is in, maybe it isn't, but ultimately it doesn't really matter. You should be investing during this whole time. You look at the history of the entire stock market, every single time it recovers and makes a new all-time high. So it's just something where if you can put money in and leave money in and not have to worry about it, it's just been a pretty good move to do that in the stock market and just kind of not really think about it and let it go to work. Things will blow over and eventually things will recover. But as always, that's gonna do it for this video, guys. Don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next video.